Start.
Well, welcome everyone. Tonight, Alex and I are going to talk and share a few things with regards to all the investment products that you have available at your fingertips when it comes to buying your first home. So we're going to be talking about all the tax-free ways you could save and invest and save for your first home.
Yeah, and there's actually three ways, which is great. There was one way that was just recently introduced, which is the first home savings account. So I'm really looking forward, Carmelo, to listening to you sharing information about that. But before we get into it, just a disclaimer, guys, we're a real estate agent and a mortgage broker. We're not like personal finance accredited people here. Everybody has their own investment goals. So just make sure that any information that you're taking away from this, you're taking for educational purposes only. You're doing your own due diligence and you're seeking the guidance of accredited third-party professionals before you're implementing anything. So basically use at your own discretion. This is just for entertainment.
Exactly. And Alex and I are going to be sharing our personal knowledge and experience with these products.
Yeah. So I guess a little bit about myself. I'm Alex Winiecki from Remax Condos Plus. Those who have attended this webinars before have probably heard this whole spiel. So I'm not really going to get too deep into it. I mean, there's a QR code there that links to my Linktree. If you want to connect on Linktree, you want to connect on social media with me, your.Toronto agent on Instagram. I'm going to be sharing the links later for both Carmelo and myself if you want to book a call with us and talk about any of the products that we're talking about or anything at all that comes to purchasing a property. But I spent over a decade in Toronto's condo industry. I've conducted over 65 condominium risk assessments. I consider myself to be a condo expert based on the experience that I have. And in 2022, I was in the top 1% for condo sales on TREB out of 70,000 realtors. And pretty sure 2023 is going to be the same. So that's a little bit about me. And talk about Carmelo, the man of the hour here.
Hey, everyone. My name is Carmelo Buttice. I'm the mortgage agent here. I've been doing mortgages for over 20 plus years. I began my career as a mortgage underwriter. And the mortgage underwriters are the people at the banks that actually review your applications to either approve or decline your application if you qualify for the mortgage. Now I'm independent. I work for yourmortgageyourway.ca. So being independent means I don't work only for one bank. I work for you and have access to multiple banks to find the mortgage that suits your best needs with the lowest interest rates, best prepayment privileges, and for the highest mortgage amount. And
so you have access to all types of lenders, from A lenders to alternative lenders.
BMO is going to be entering the mortgage broker channel this year. It's going to become slowly in phases, but they're another one of the big banks. The monoline lenders that are prime lenders, alternative lenders that have different guidelines to cater for those who are self-employed or contract or commission. There's a whole variety of different banks out there than the big five.
Nice. Very nice, Carmelo. Thank you very much. So I don't know. Why don't you get us started here? Let's talk about, this is the old school one that's been around the longest, right? The RRSPs.
Yeah. So the RRSPs is the first tool that really came out to Canadians, and it was actually introduced way back in 1957. Now, this account was introduced for Canadians to start saving money for retirement, because back after the war, that's when they created the CPP, and people felt that wouldn't be enough for Canadians to retire. So they created another tool, another account for Canadians to save on their own and create their own future in retirement to save. And then afterwards in 1992, they introduced where you could start taking money, the RRSPs, to buy your first home. Now, since with the initial introduction, the withdrawal, the amount of money you could take out of your RRSPs was really low. But in 2019, just a few years ago, they've increased the withdrawal limit to $35,000. So now, if you have $35,000 in your RRSPs and you're looking at buying your first home, you can withdraw that money, not pay any taxes on it, and use that to purchase your first home. Now, with the withdrawal, there is going to be a 2-year grace period. The year you take the money out and the next year. But you do have to pay that back. You're really essentially giving a loan to yourself with no interest.
Yeah. And 35,000, I mean, that's a significant amount. Like if somebody's looking to for example, purchase a condo, let's say the cost 600,000, and they're going to be residing there, like I believe 35,000 is based on the requirements that would meet that, right? Like that's $100,000 condo.
That's exactly the minimum you need to put that for down payment on a $600,000 property.
Yeah, and this is just one of the tools that's available. But I have a question here about this last point on your slide there. So you can withdraw multiple times as long as you haven't owned a principal residence the last 5 years. So does this mean that I buy a condo today, I use I use this $35,000, then 5 years down the road I want to upsize and sell the condo, buy a townhouse? Can I take money again out of my RSPs at that point?
So the answer to that, Alex, is unfortunately no. Because again, you could withdraw from your RSPs multiple times, provided you have not owned a principal residence in the last 5 years. Your example is you purchased. After 5 years, you want to upsize, it sounds like.
Yeah. So, okay. First of all, okay, do we want to address questions now or do we want questions at the end?
If we can say maybe save the questions for the end, if that's okay. Because I know that we go through the slides, it'll only take about 10 minutes.
Okay. But, okay, so just so I understand you correctly with this withdrawal, it's like I buy a condo today. Let's say I own it for 3 years. I sell the condo. I go, I don't know, live with my parents for 5 years. At that point, after that 5 year period, then I can again withdraw from my RSPs to purchase another property for me to live in, right?
Correct. As long as the previous withdrawal you had has already been repaid.
Okay. Yeah, that's right.
Exactly. In that case, you bought after 3 years, you sold. 5 years went by. You want to take out again. As long as you repaid that previous one, yes, you could do it multiple times. You're not limited to only one time, which is a big a big thing people just aren't even aware of. Everyone thinks it's only one time.
I thought it was one time for the longest time as well. There's a lot of misinformation out there. So, be careful who you're getting information from, because, things like this can really create opportunity for somebody. But also if you are not aware of it, then, you're not aware of that opportunity as well. Okay. So let me talk a bit about TFSAs, if that's okay.
Yeah.
Okay. So TFSA is a tax-free savings account. It was introduced in 2009. Basically, the way that the TFSA works, Carmelo, correct me if I'm wrong, it's like you invest a certain amount of money. I think it's capped at what, like $7,000 a year. Is that correct?
That's for this year. $7,000 this year. Okay,
$7,000 this year. So if I'm investing this, like let's say I'm buying shares of Apple, for example, and then I sell those shares of Apple, the proceeds are not going to be taxed as income. Is that the way that it works?
Correct.
So it shelters me from having to pay income tax. However, the limit is only about $7,000 a year. But this all started in 2009. So if you were of the age of majority in 2009, by 2024, you should have about $95,000 of potential TFSA room that you can use in this way.
Correct. So, as you're bang on, Alex. Again, tax-free savings account it's a tool to help. The incentive is for Canadians to put money aside for savings, or whether you're earning interest, income, capital, anything in all income, all profits that are made in there, you don't pay any taxes on.
So, if I had $95,000, but let's say that's my book value. That's the amount of money that I put in, but the actual market value of the assets is like, I don't know, 120,000. Those difference between 120 and 95, I'm not paying taxes on that? Or
exactly. When you take the money out, you pay taxes on that 25,000 profit, you pay no taxes.
Okay. So it looks at basically not what is the market value of the TFSA, let's call it portfolio. It talks about the book value, which is how much money you actually put into the account.
Correct. Yeah, you could take. Let's just say you started in 2009, and you could be at 200,000 today.
Okay.
You could take that full 200,000 out and not pay any taxes, and all those years as that account accumulated the money, whether it's interest, income, capital gains, was never taxed.
Very nice. Very interesting.
So it's a real cool account. Because again, taxes is a big burden for Canadians, and this is one way to help kind of shelter from paying more taxes.
Okay, so let's talk about the baby, the new one here, the FHSA.
This is the brand new account that was introduced just April of last year. It's not even 1 year old. This was a new account that the Liberals introduced. As another tool, another savings account, or another account where Canadians could put money aside to purchase their first home. Now, this is strictly just a first home savings account, not for anything else. And again, one thing with this account is the incentive is when you put money into the account, similar to like your RRSP, the money you put into it, the contributions, get deducted from your income for your income taxes. The cool thing with this account, it also has features like the tax-free savings account where any investments, capital gains, interest, dividends all grow each year. You don't pay any taxes on. And the one cool thing with this account versus the RSPs is when you take the money out of this account, you do not have any repayments to it. This is just a one-time. You put the money in a first home savings account, and again, like the annual contribution limit is $8,000 per year. So last year's $8,000, this year's $8,000. As the account's only 2 years old, the maximum room is $16,000, but it comes with a total life as the years go by, a maximum contribution of $40,000. This has like the features like an RSPs where you put money in, it helps saves on your income taxes, but also has the features like the tax-free savings account where you get a lot of profits and a lot of capital gains. When you take the money out, you're not taxed on it, and you do not have to pay it back.
Okay, but unlike the RRSP, this is not something where you can use it and then you buy a property, then you go live with your parents for 5 years, and then you want to buy another principal residence. You cannot use this twice. Like, they just won't let you open it, or
this is just, again, that's why it's called first. So I think it's just a one-time. It will find out 5 years from now, 10 years from now if they make any adjustments to it. But right now, it's just solely one time to purchase.
So it's 3 nice tools to shelter your savings from tax and use that towards purchasing a home. Excellent.
Now, the key thing is, what's the difference between all these? Because we just went over 3 accounts that kind of get confusing. So this chart kind of explains, like, is the account tax deductible? So what that means is when you put money into the account, can you deduct it from your income taxes? So tax-free savings accounts, you're not allowed to do that. You're not allowed to deduct the income. Or you're not allowed to deduct your contribution. With an RSP and tax-free savings account, you are allowed to deduct the contribution from your income.
I didn't know that you can do that with TFSAs.
TFSAs, you cannot. There's an X.
Oh, first home savings account, you cannot.
No, first home savings account, you can. There's a check mark.
Yeah, sorry, I got them confused because they both start with tax-free here on this slide. So the first home savings account and the RRSPs, you can deduct the contribution from your income tax for that year. Tax-free savings, you cannot.
Correct.
Okay.
Now, is there a withdrawal fee from tax-free savings account? No. Okay. Can there be withdrawal fees? There can be if you're doing if you're not doing it for your first-time buyers, and if you're doing it for you're doing more than $35,000. Same thing with the first home savings account. Yes, there can be fees if you're doing it for a transaction that doesn't qualify. Okay. So there can be fees withdraw from the RSPs and first home savings account if you're doing it for purposes that do not qualify for that account.
Right. Like if you're opening the RSPs just to like take that money and pay some bills.
Yeah, you can't take money out of RSPs to buy a new car, pay some bills.
Well, I mean, you can, but you have to pay tax on all of that.
Exactly. Yeah, there'll be I call it a withdrawal fee.
Yeah.
Can withdrawals be tax-free? In a tax-free savings account? Yes. All withdrawals are tax-free. Okay. And that actually is applicable to all of them as long as you're using it in accordance for buying the home.
Nice.
What can you invest in are you allowed to invest in each account? The answer is with all the accounts you can invest in: stocks, bonds, mutual funds, exchange traded funds, money market funds, just the banks, high interest savings accounts. A whole variety of investments can be used. They could invest in with each account. The last the difference between all of them is, do these accounts expire? Tax-free savings accounts do not expire. RRSPs do not expire. First home savings accounts, you must close the account within 15 years from you start it. Meaning if you're opening it, the life of the account is 15 years. If you don't buy that property within 15 years, we'll see what happens. What the penalty will be, but there'll probably be something along the line. And if you're opening that account, I'm hoping you are going to be buying within 15 years, and you don't have to worry about any expiration.
Nice. Yeah, interesting to see about that. Probably it'll be kind of treated the same as RRSPs, where you'll just take that money and have to pay taxes on it and, call it a day. But I mean, this is great tools because, especially with the RRSPs and the FHSA, like let's say you're earning, I don't know, $90,000, but you contribute $20,000 into these two accounts, you're only going to be paying tax on like $70,000. So you're sheltering yourself from tax, and you're putting money to, save for your home. Really
good idea, Alex. I actually thought about something like that already. So I just kind of went on, those online income tax, portals, let's just call them.
Mm-hmm.
And I use the example, like if someone today has if you got 51,000 set aside and you have not started an RSPs,
mm-hmm.
you can put 16,000 in that first home savings account and 35,000 in your RSPs right away. Okay. So if we're in Ontario, so I use Ontario's example. Let's just say your income is 120,000. If your income is 120,000, you're going to be paying $29,682 in taxes. Crazy. Now, if you end up maxing both of them out, again, because that first home savings account, they're not lined, it hasn't really been accounted for, but it works the same as RSPs. So I'm just saying your RSP contribution is $51,000.
Okay.
That means you're only going to pay $12,037 in taxes. There's a difference of $17,600.
And you can also take that money out to use that for your down payment.
Well, that $17,600 is money you use for down payment to buy a home. You could get, if you do this, at least the RSPs, the strategy is you do it before the RSP deadline. The sooner you put the money in your RSPs, the monies have to stay in your RSPs for 90 days. Okay. So don't wait till February 28th to put the money in RSPs. Do it as soon as possible. Because the sooner you put it in, the sooner you take that money out to purchase your property. And at the same time, you do your taxes right away. If you only had 51,000 in savings, well, now you got 51,000 plus you get a refund of 17,600.
Yeah, so now you have like 67,000 or something like that.
68,600. And this is just if you max it out. You don't have to max out both if you don't have that much money. But the strategy of putting money into these accounts before you do your taxes and before the RSP deadline is very important because you get the refund right away. If you put the money in RSPs on March 3rd, March 4th, you have to wait till 2025.
Yeah. So it's very timely that we're doing this presentation and sharing this slide. And, we've shared this slide in other presentations that we did last week as well, because, if your intention is to buy a home for your principal residence in 2024, you have a window that's going to be rapidly closing because we're already, a week into February, and you have until February 28th. So this is why we're including this. This is why we're going to be sharing other information about this with the Meetup community and on our social medias as well.
Yeah, this is again, I like to think of it as a hack, and this is the hack that you don't hear at the banks, which is, it kind of surprises me. Like the banks should be promoting this, you think, to get more money, but they're not.
I wonder why, but like it's what it is.
Yeah. So now's the time. If anyone's got questions, it's kind of